Hello, everyone, and welcome to another edition of the show. And I hope you all had a wonderful weekend and a wonderful trading week last week. Now, for those of you who would like a visual representation of the show, you can go to smartinvestorcentral.com and go to market updates, where we'll have the actual chart, the charts that we're looking on to see exactly what is happening in the markets. Okay, last week on the S&P 500, we had a positive week. The market moved up slightly, and importantly, we did get a close above this 1950 area. And the 1950 area is was acting as resistance in the market, this 1950 area here, and we did get a slight close above this area. What we would like to see is the market continue to move above 1950 on S&P 500 and probably challenge this 2000 resistance point. And if that happens, that will relieve some pressure on on the downside that we have been experiencing over the last couple of weeks in the S&P 500. Now, the S&P 500 at this point in time, just to give you some background, remember we have we have been in a bull market for the last couple of years. The bull market is higher highs, higher lows in the markets. That's what a bull market is. Now, last year in the S&P 500, what happened? We saw a market that moved essentially sideways from 2015. We saw a market just doing a sideways action, and we did have a dip in August. The market went back up, did not take out this high, the high near the 2100 level, and we dipped back down, and we have a slight rally to where we are now. So what's happening in the S&P 500? Looks like we could be in a topping out action. Now, the only thing that will relieve the pressure from the downside is for us to take out these highs here in the S&P 500 around the 2100 level. So we are in a consolidation pattern at this time, and I'm just marking the area on the chart here. We're in a consolidation pattern, and taking a look at the monthly chart, if we do close below this 1800 level, as we see, this 1800 level has acted as support over the last. It acted as support in October 2014. It came down in January 2016 and also February 2016. So if we do close below this 1800 level, that will be fairly bearish for the markets. But what we could see in the next couple of weeks is the market just meander between 2100 and 1800, which so that will be essentially a sideways market. So that could also happen in the markets. Taking a look at the Dow Jones Industrial Average, we see also the Dow picture of the Dow looks pretty similar to the S&P 500. We have pretty strong support just above the 15,000, above the 15,000 level, and this support is fairly strong, as it was tested back in 2014. We saw a test in 2014. The market came back down in 2015 and 2016. Just about this 15,300 area is pretty strong support in the Dow Jones Industrial Average. A close below that level will open up the downside, and we could see the market quickly go down to 15,000 and also to the 14,000 level on the Dow Jones Industrial Average. Taking a look at the Nasdaq futures this morning, we see a market that has found support near the 3,900 level, but is encountering strong resistance up at the 4,300 level. So for the Nasdaq, we would like to see the market close above this 4,300 level in the Nasdaq. Now, strong support in the Nasdaq comes in at 3,800, the 3,800 level. Taking a look at the futures this morning, we see from the start of the European session, we saw the market move to the downside, and we had some negative price action. Currently, what we do is we see that the market has dipped back up into positive territory. The Dow futures are up 15 points. S&P 500 are down, or is up 2.75, and the Nasdaq is up 0.62 points. So, from a market that started lower, and we have turned back up in the last couple of hours. Now, moving overseas, taking a look at the FTSE, we see a market also trying to recover. But the dangerous thing we see here in the FTSE is a series of lower highs and lower lows. This market topped out back in May of 2014, and ever since then we have seen a series of lower highs and lower lows in the FTSE, which is definitely very troubling. Critical support in the FTSE comes in at the not the FTSE, sorry, the UK, the FTSE, the UK FTSE. Critical support comes in at this 5,400 level, the 56 to 5,400 level. If we see the market continue below the 5,400 level, that would be fairly bearish for this market. And what that would do is continue the series of lower highs, lower lows in the FTSE. I've been saying that the chart of the FTSE has been fairly weak, and if we're looking to short a market, this wouldn't be a bad market to go short on. Taking a look at the German DAX, we see a market also seeing some lower highs and lower lows. The market topped out back in April of 2015, and ever since then we have been seeing lower highs and lower lows in the UK FTSE. And lower highs, lower lows can be the precursor to a bear market. If we do close below the swing low of 8,500, that would be very bearish for this market, and we could see even further losses on the German DAX. Taking a look at the CAC 40, similar looking chart to the German DAX, where we see the market also in a series of lower highs and lower lows. This market topped out back in April of 2015, and we have just been seeing lower highs and lower lows ever since then. Critical support in the CAC 40 is at the 3,800 level. Now, taking a look at the Nikkei over in Asia, we see a market here that is looking very troubling. Again, this market topped in this August-July region, and the market has been correcting ever since then. If this market closes below this 14,000 level, that would be very bearish and could even signal a deeper correction in the Nikkei. But right now we are definitely in a corrective posture. Now, what I want to draw your attention to is the fact that most of these markets topped out in the April to August time frame of last year. And what we're seeing now are markets that are moving to the downside. Now, they are not moving to the downside rapidly, but they are slowly trending to the downside. And what we're starting to see is the market is this bearish sentiment and creeping into the market. And the media at this point in time is not really picking up much on this. Everything, the VIX, even looking at today, we see the VIX relatively low. We see the VIX currently at the VIX is at 1981, historically very low. And although the market is creeping to the downside. And this is something that you as an investor need to keep an eye out on. And what could happen is that if the markets break these all important support areas, we could see a wave of selling in the markets, and that is when the media will start to really pay attention to a sell off. And that's why it's important to look at chart patterns and look at what prices are doing, because prices can indicate to you what is happening in the markets long before the media steps in. Because over the last couple of months in the S&P 500, we have been seeing a rounding. Taking a look at the monthly chart, what we see here is a rounding. Market came up, market is rounding off. We see as a top could be forming in this market. This market could be topping out at this point in time. Yes, we have had a couple of months of essentially sideways price action. Market is contained between 1800 and 2100 on the S&P 500 index, and that's why investors at this point in time, most of them are not even paying attention to what's happening. The average investor right now, yes, they're seeing the market go up, it's going down, but it looks like it's going nowhere fast. And if we do get a really strong close below these levels, that's when a wave of selling could bring this market down to the 1400, 1300, even the 1000 level on the S&P 500. And looking at the Dow Jones Industrial Average, as most people pay attention to the Dow, we could see a market correct down into the 7,000 level. We could see the market go to 12,000, 10,000, and 7,000. Bear in mind that, and if you want to take a look at the charts that I'm referring to, you can go to smartinvestorcentral.com, market update. And bear in mind that in 2000, this is a rally that we saw in 2001 to 2008, 2007, 2008. And what we saw in the financial crisis of 2008 is the market correct just over 100% of this move to the upside. And so when folks say that markets cannot go back down, they are ignoring recent history, because if a market really starts to move to the downside, what it could do is correct 100% of this move from 2009 up to 2015. We could see our market move all the way back down, even into the 6,000 level on the Dow Jones Industrial Average. It is entirely possible. So keep an eye out on that. Taking a look at the US dollar index, US dollar index has been fairly positive over the last couple of weeks. We see the market moving to new new highs for the latter half of February, where we see the market moving up to the 98.31 level. Resistance in the US dollar index comes in at 100, and we have to keep an eye out on the previous high in the US dollar index near this 101 level. And what we could be doing at this point in time is that the market could be forming a triangular consolidation pattern where we could challenge this high and even break above the high. Naturally, we will have to see what the reaction in the market will be, but this is something we are going to keep an eye out on. Taking a look at the gold market, we did have a break above previous highs in gold, where the market closed above this all-important 1190 region. Market came up and has been moving sideways ever since then. Support in gold is where the previous breakout occurred, and this is at 1190. This is 1190's previous support. I've drawn the red line on the chart. This is support. If we see the market closing below this area, we could be in for further selling down to 1140 region or so. Taking a look at, so gold right now is slightly positive. I would say the tide could be changing in gold. We had a 5-year bear market in gold, lower highs and lower lows on the charts. It's a weekly chart of gold, and this could be the beginning of a turnaround situation in gold. Naturally, we'll have to wait and see, but and I'll keep you abreast as to whether this turnaround situation actually materializes. Taking a look at the crude oil market, we have a market that is still in a pretty strong downtrend, although we have had some price recovery over the last couple of weeks. But remember that this market is still in a fairly strong bear market, down market move, and we could see sellers come into the market at any time and drive this price action down even further. Okay, so that's essentially what's happening on the charts with this week. The We're still looking in the S&P 500, especially. This is the chart I am paying very close attention to. We're still looking at a market that is in an area of indecision. If we close above 2100, the bull market could continue for another couple of months. If we do not and we close to the downside, what we could see is a sell off in the market. So we just have to keep an eye out and see what's happening in the S&P 500 especially. Okay, thank you very much for listening to the show, and remember, it's important to follow what prices are doing, follow what the price action is telling you, and not what the mainstream media, the constant noise of the mainstream media, because the prices can give you an indication of what exactly is happening in the markets and not the media. Thank you very much for listening to the podcast, and I hope you have a wonderful investing and trading week. Thanks.